Hello, doctor. My name is Leng. My membership number is 2798113. This is my BWRR 3073 Credit Risk Management individual presentations. In this presentation, we are mainly focused about the effects of internal and external factors on the credit risk of overseas Chinese banking corporations, which is OCBC Bank, from years 2017 to year 2021. Next, I will talk about the problem statement. The problem statement is credit risk is the probability of a financial losses resulting from a borrower failure to repay their loans. According to YLE on 2020, due to the spread of the coronavirus, which is COVID-19, has bring big influence on the market and also economies. This unpredictable disaster has brought big influence on the Singapore three largest banking industry. These three largest banking industry, which are DBS Group, OCBC, and also United Overseas Bank. The COVID-19 pandemic has increased the credit risk of these three banks and make most of their loans they do it during good time become bad loans. And this COVID-19 pandemic has also increased the potential loan loss for all those banks. Research objective and question. There are three research objectives and questions in this assignment. The first research objective in this assignment are to find out the internal factors or firm-specific factors that could influence on OCBC credit risk. The second objective is to identify the external or macroeconomic factors that have influence on OCBC credit risk. And lastly is to analyze the internal and external factors that could have influence on OCBC bank credit risk. The research question is, what is the relationship between the internal factors with OCBC bank credit risk? The second question is, what is the relationship between the external factor with OCBC bank credit risk? And also lastly, the question is, what is the relationship between external factors and internal factors with OCBC credit risk? Next, I will talk about the literature review. In this assignment, we are mainly focused on credit risk. Credit risk is the possibility of a lender losing their expectation to a third party that fail to fulfill their commitments. Credit risk is also one of the oldest forms of risk that everyone in the financial industry will face or go through. The failure of a company in their credit risk management may lead their company to a negative or bad financial conditions, and even worse, or might also cause bankrupt. There is a framework which called 5Cs that can help the company to understand and measure the credit risk. In this study, the internal factors that we mainly focus are ROA, liquidity risk, loan loss provisions, debit to equity ratio, debit to total asset ratio, equity multiple, tier 1 capitals to total asset ratio, leverage, capital adequate ratio, and also interest income to average loans outstanding. The external factor that we focus on this study is GDP, inflation rate, interest rate, unemployment rate, and also standard deviations, which is market risk. Methodology. In this study, there are four methods of methodology that we're using. The first is sampling technique. OCBC has been chosen in this study. 5-year annual reports, which is from years 2017 to year 2021, has been selected to identify the relationship between OCBC bank credit risk with internal and external factors. The second one is the statistical technique, which we use to investigate how the internal and external factors affect the organization ratio and how well the business or company perform with it. Third is the data analysis, which is a multi-regression analysis that we use to analyze the impact of the independent variable on the dependent variable. The impact of the independent variable on dependent variable. And lastly, which is SPSS. We use SPSS to analyzing the quantitative data from the annual report and the website to descriptive statistics. Next, I will talk about the finding analysis. From the descriptive statistic tables, the mean of the credit risk is 0.0200 and standard deviation of 0.0006, which means that OCBC has stable and predictable credit risk and they can assess the effectiveness of their risk management. From the table, we also can notice that the equity multiples has the highest mean of 17.4583 and loan loss provision has the lowest mean of 0.0048. Next will be the correlation table. From the correlation table, we can notice that the relationship between the credit risk and standard deviation, which is market risk, is less significant because the p-value for standard deviation is 0.083, which is lower than 0.1. From that, we can know that if the market risk increase, the credit risk of OCBC Bank might also increase, which also means that the credit risk is influenced by the market risk of the banking institutions. Then, from the table, we also can notice that other 16 independent variables are mostly not significant because all the p-value are more than 0.1. Next will be the model summary table. There are 3 model summary tables. First will be the internal model summary tables. From the internal model summary table, we can see that there are 3 variables that contribute to the credit risk of OCBC, which are leverage, interest income to annual average of loan outstanding, and also debit to total asset ratio. Next, second will be the external. For the external, there are also 3, which are standard deviations, unemployment rate, and interest rate. And lastly, for the internal and external, there are standard deviations, loan loss provision, and also Tier 1 capital to total asset ratio. We can notice that from these 3 tables, their adjusted out square are negative. This is because all these 3 model summary did not explain well of the credit risk. And then from the Dubin-Watsons, you can see that the internal model summary has negative autocorrelations to the credit risk of OCBC because its value is between 2 to 4. And from the Dubin-Watson, we can notice that the external and also internal and externals are positive autocorrelations because their value is lower than 2. Okay, next will be the ANOVA tables. From the 3 ANOVA table here, we can notice that all these 3 ANOVA tables are all not significant to the credit risk because their p-value are all more than 0.1. Next will be the coefficient table. For the coefficient table, we can notice that all the variables are not significant because their p-value is more than 0.1, and we also can notice that some of the variables are negative relationship to the credit risk. Lastly will be the conclusion and recommendations. As a conclusions, this is a less reliable research because most of the independent variables are not significant to the dependent variable. This issue happened because the sample size is too small and cause the study lack of the statistical powers to detect the significant relationships. But I suggest that OCBC should focus and actions on the significant variables, which are standard deviations, or we call it market risk, to control the credit risk of the banks so that OCBC can lower the potential of financial losses from the loan default. That's all for my presentation. Thank you.